I'm Mark Payton, co-founder of Mercia, CEO. I've got over 2 decades actually of investing, creating tech businesses, selling tech businesses on. Joined with Martin today.
Yes. Hi, good evening, everyone. I joined Mark just over 10 years ago when there were 7 of us to float the business. And as you'll learn through this brief presentation, we've come quite a long way since then.
Yeah, and it's great to be back actually again, presenting to here. So we'll talk a little bit about that journey, what we are, what we're trying to do, how we're trying to make a difference. We'll also talk to the 3-year strategic plan. We're almost a year through what we call Mercia 27. Martin will talk to our interim financial results after that, and of course the broader sort of market philosophy, the drivers, the value drivers, and how we think those tailwinds, not headwinds, are out there are really an advantage to us. So what is Mercia? We are now a fast-growing, scalable, and leading alternative asset manager. We focus on the private markets, and we see the deals to invest in that others do not see. We focus on a market place within the UK which has multi-billions invested every year, and we're focused in particular in the strategic assets of private equity, venture, debt, but also we've now made a move into real assets, and we're moving towards that area too. And the differentiation that we actually deliver is one of deal origination. We've always said that there's 2 platforms that we must absolutely nail. Deal origination, how do we see the deals that others don't? How do we see high quality deals? And sales and distribution, how do we ensure that we have the capital to match the opportunity? And as those opportunities grow and develop, how do we have growing pools of capital? We'll talk a little bit more about that in a moment. But actually, Martin mentioned 10 years. This was why we set about our journey. Is that, and these are the latest published stats, and the alarming thing is it's not changing a lot actually in regard to the UK. So in 2021, for high growth businesses, and high growth businesses are defined as growing by headcount 20% per annum over 3 years. 12,600 high growth businesses in the UK, 21% of those based in London. However, 66% of all capital deployed is into UK businesses that are London-based. So in other words, a disproportionate amount of money going into London-based businesses and not outside of London. And the big question is, and the question we asked is, why? And it's because, and we firmly believe on this, is you have to be physically located where those great investment opportunities are. And I'm hopeful that I will persuade you that is a fact as we go through this. But we now have 11 offices across the UK. We're in the intermediary community, we're talking to founders, management teams all the time, and we have this ambition to always be the first choice. That first conversation is with us, and that's something we've worked really, really hard at. And that's really reflected in the fact now that we see over 2,000 business plans and requests for investment per year, and we're approximately investing in about 5% of what we see in that respect as well. And these are figures taken from our full year to the 31st of March 2024. And in that same period, we invested £243 million in that 12-month period, 126 in venture, 18 in development capital, and by development capital I mean debt and private equity, and 99 million in property lending, and an area that we're moving more and more into, particularly the likes of logistics, affordable housing, etc. And what you can see on that schematic of the United Kingdom is where those investment sizes are. So you've got the Northern Line there, 5 million. You can see the quantums of capital we're deploying across the UK. And you can see there that about 90% of that is outside of London. And actually, in that 10-year journey that we've been doing this, we've invested now 1.2 billion. And again, you look at those numbers, you can very quickly see that about 90% of what we've done in total is outside of London. So actually firmly being outside of London and physically being outside of London has meant that we've got to see some excellent deals. And the reason why I say they're excellent deals, there's some names there you might recognise. And we have been fortunate enough to make investments where we have returned 100 times our money. We do invest in young businesses and follow through. We go into private equity, profitable businesses. We lend money to profitable businesses. So we like to think that we have pools of capital for the business needs, but the consistency across those businesses' needs is they're growing. And we're there to fund and support their growth. And there's now, I'm sure you picked up a bottle of spring water, Harrogate spring water. We've lent money to Harrogate spring water. Current Body, you might have read in the papers about a business, quite a high profile business, planning an IPO. We're a young investor in that. We invested in it when it was not profitable. It's now a highly cash generative and profitable businesses. And there's a whole host of names there. Kirsty's, if you go into Sainsbury's, Tesco's, Asda, you'll see those dairy-free, gluten-free products in there. Again, we're an investor in that. And for those that are dog owners, like I have recently become, Pure Pet is something that I would really encourage. Newcastle-based business, started off as a couple of people founding it, now very fast-growing business. It's got a really neat software tech connected to traditional technology. So it bespokes what you believe your breed of dog will require. It learns over time whether that's right or not. We get our food delivered to Jasper, not to me. So it goes to our dog. And it is incredibly compelling to carry on doing that. I also get a fee, actually, if anybody else uses it, so I can recommend it later on. But I mean, joking aside, it's a great example of a business where you have an innovative technology development platform going on. You've got two really innovative entrepreneurs who came to us for support, but they're using people from the bakery industry to help them to assemble the ingredients in a very traditional warehousing sort of place. So it's got lots of pools of talent from different industries coming together in a highly scalable business. So there's some good examples of what we see across the UK from our regional offices. And it has been for us a 10-year growth journey so far. And across that 10 years, we floated December 2014, we've also made 3 acquisitions to accelerate our own growth. We're impatient to grow the business as well. So about half of the assets under management, our AUM, have come through acquisition, and the other half through organic growth. So acquisitions is a really important part of really compressing time and accelerating our own journey. And in terms of that growth journey, every circa 3 years, we've grown by 100%. We are a highly scalable, high-growth business at the moment. At IPO, we had 23 million in third-party funds, which felt like an enormous amount of money, I have to confess, back then. But today, we've got we manage 1.6 billion of other people's money to deploy and invest, and I'll talk later on about those pools of capital. And you can just follow this all the way through in terms of growth metrics, from the investment size on average through to how much we used to invest 2 million in a 6-month period. We invest over 100 million now every 6 months. So in every aspect, we're cash generative, high growth, profitable. We're on what we call a progressive dividend policy journey at the moment. We're returning money back to loyal shareholders in that respect. And so the Mercia 27, so this is our strategic journey that we set out 31st of March last year, 2024. And it's really to take us from where we were at that period, which is 1.8 billion in total in assets under management, 5.5 million EBITDA, 18% EBITDA margin, that progressive dividend policy I talked about, but also simplifying the business. So Mercia originally started off as a managed fund business where we would invest our own money into businesses coming out of those managed funds. And that's how we started it. And we made the decision last year to simplify the business. And by doing that, we are no longer adding businesses, direct investments to the balance sheet, and have made a commitment to sell down the balance sheet over the next 3 years, approximately 70% by value, using that money to facilitate our own continued growth. In other words, not going back to the market to raise money, but using our own resources to continue our own growth in that respect. We felt that was a compelling way to fund that further growth. And that further growth is to take us to 3 billion in AUM. So to my point, every 3 years, almost 100% growing. To take EBITDA up to circa 10 million, take the margin up to circa 26%. And as I said, to finance growth through divesting our own balance sheet assets. And this shows you that we're good at doing that. We can sell our businesses. We are good at picking winners. And I think in terms of asset managers, that you are looking for asset managers who can pick winners and realise their potential. What you've got here are various businesses that we've held directly on the balance sheet over the years in terms of the investment that we've put into them, the exit that we've made from them. Those are cash exits, full cash back to us, and then the returns metrics. So we're making about 3 times invested capital on our direct investments. And it's that piece that we are going to be running down to scale the growth of the business going forwards.
So if I may, I'll just take a few minutes to give you a feel for the financial momentum of the business at the moment. Thanks, Mark. So this is a summary of our first half results for the 6 months of September 24 that we announced in November. Obviously, we're now just approaching the end of our full year at the end of March. And you can see here, we have real momentum. So 19% increase in revenues in the first half, 34% increase in EBITDA. We increased the interim dividend by 6% that we paid in January. in a relatively quiet period for the asset management industry where many other businesses have been suffering redemptions. We're fortunate not to experience redemptions because our funds are typically closed end. So we actually had 57 million of organic fund inflows during that 6-month period. We have no debt on our balance sheet currently, and in fact we had 46.2 million of cash in the bank. In the early years post IPO, we earned pretty much nothing on that, and of course these days we've been earning 4 or 5%, which has been a real contributor to cash generation in the business. Our balance sheet portfolio that Mark's just mentioned is currently valued at about 121 million pounds, and that is what over time we're going to turn back into cash. And as Mark's mentioned, we have 1.8 billion in total under management. 1.6 billion is our funds under management, and the other 200 million is our balance sheet in total, roughly. And of that 1.8 billion, currently, we have about 663 million of dry powder. So that is 2 to 3 years of investment capacity to support both our existing investments, which are over 500 companies now, plus investing in new opportunities as well. So to give you a little bit more feel for the momentum that I've just referred to, you can see here that the first chart is our revenue growth. This is year on year, 6 months on 6 months, growing our revenues by 19%, you can see there. And we earn about a blended fee margin of circa 2% on the funds under management. And that, compared with, I guess, the asset management industry overall, is a very good fee margin. 82% of our revenues are contracted and recurring, which is when I'm doing the budgets every year, that's a great place to start, when you can sort of bank 82% of your revenues. And the remaining revenues, they come from the transaction revenues when we actually put the money to work. Only 2% of our revenues are now coming from our balance sheet activity along the portfolio. So 98% now of our revenues are coming from that growing funds under management. That momentum in revenue is also, you can see here in our EBITDA, which was up 34%. So we are beginning now with our scale, we're beginning now to see the cost efficiencies coming through where we can drive a greater percentage EBITDA growth relative to our revenue growth. And a first half EBITDA margin of 21%, and we're looking to drive that, as Mark said, to up to 26% by the end of March 27. And in terms of cash generation, are we turning that EBITDA actually into cash? Well, we're doing slightly better than that. Our operating cash generation in the first half was slightly over 100% of our reported EBITDA. And the beauty of that, our model is that we have negligible working capital needs and negligible CapEx. So we are able to turn those profits into cash every year. In terms of our assets under management, in the first half, we started at 1.8 and we finished at 1.8. We generated 57 million pounds of inflows, as I mentioned, and the only real outflows were distributions to our shareholders and to our fund investors. So we manage the Northern VCTs, as you may know, and obviously they are paying a yield of circa 5% over each year on the assets under management. Thank you. This slide gives you a feel for those assets under management by asset class, by investor type, and by the fund type. And you can see, as I've said, blended 2% fee margin. These are very long-dated funds. I say we don't suffer redemptions, fortunately. So as you can see, we've got a great spread of diversity across our venture, our balance sheet, our SME loans, our debt, and our private equity business. And also our clients, the people who give us the money to invest. Again, we have a very good blend of institutional investors, public sector investors, and our retail investors, which is our EIS and our VCT investors. And then in terms of the nature of those types of funds, we have LP funds, it's a venture capital trust, our EIS funds, and a whole range of other types of fund management contracts. We're managing, at the half year, we were managing 64 separate fund management contracts, and now we're up to about, 67. I won't bore you too much with the numbers anymore, but this just gives you, more granularity on our income statement. You can see the revenue growth there, you can see the EBITDA growth, and then down at the finance income line there, you can see that bank interest, deposit interest that I was referring to. And we have money on deposit in a money market account at BlackRock. But our cash is well spread across 4 or 5 UK banks. So you'll be familiar with Lloyds, HSBC, Barclays, etc. Here's our very strong balance sheet. The 6 million of cash you can see there, and you can see there the 121 million of balance sheet portfolio. And with that amount of cash, relatively low amount of money deployed into the balance sheet portfolio compared with historically in the first half. And that is a sign of the emerging maturity of that balance sheet portfolio, which is currently 20 companies, which we're not going to add any more to. And given the strength of the business and the momentum, as I said, we were able to announce an increase in the interim dividend by 6%. We have a really simple thank goodness, we have a really simple cash flow statement. So no big capex. We turn our EBITDA into cash. And really the only other things in the balance sheet in that period was the 3.9 million of balance sheet investment into the portfolio, the interest received on our cash deposits. And as you may also have known, we completed a £5 million share buyback, which started in November last year. In November 23, finished in May. And you can see there the 1.8 million that was paid to shareholders who sold their shares to us, back to us. Thank you.
Thank you. So just these last couple of slides talk a little bit about the market drivers, the asset pools that we manage, etc. And I think it's important, I said, and it wasn't meant to be flippant, that we're good at picking winners. We've returned, since our IPO, over £800 million back to our fund investors. So, I believe the answer to are you good at picking winners is your ability to return cash back to investors. And I think that is the reason why we have high confidence for our AUM to continue to grow, because we're increasingly seen as a good choice investor to deploy other people's capital. And then in terms of what we mean by other people's capital, we have three really, pools that Martin just referred to, actually: retail, public sector and institution. I'll just dive down to each one of those three so you can further understand what we're doing and the size of the opportunity. So for us, retail means venture capital trusts, VCTs, the Northern VCTs, and enterprise investment scheme, EIS money. There are other pools of tax efficient capital, BPR, etc., but we currently only operate in those two areas. We're typically backing businesses that have got 1 to 50 employees, as I said, a majority outside of London, but we don't discount London. I mean, although we're doing 90% outside of London, we are doing 10% in London. We have a great London office and we see great deals there. It's just that we see great deals everywhere and London. And we're typically investing £1 to £10 million in those businesses, sometimes up to 20, but typically in the 1 to 10 range. We manage about 2.5% of that total addressable market. So plenty to go after. You can see us moving in the tables, particularly for VCTs. We're climbing those ranks, so we would expect to be able to grow further in that space. Within the public sector, broadly for us, that's predominantly British Business Bank. And British Business Bank is a really important provider of capital to third parties to deliver capital on their behalf. Now, British Business Bank manages and deploys a whole suite of funds. What this focuses down on to the regional venture and the regional debt funds. So this line in the middle here is talking about that. There's 2.5 billion just in that one area. We're talking to BBB about other areas, but just within that area is 2.5 billion. And we manage 22% of that. And that's really on the back of track record. We are out there, we are making businesses happen and develop against managers' expectations, and we're delivering returns back to what frankly is the taxpayer. So that is a really important initiative they do, and we feel very proud to be part of that. Importantly, there's further top-ups that come into those funds. We are originating those deals, we are deploying that capital, and we expect those top-ups in the fullness of time to come to us as well, into existing funds. Institutional capital for us is predominantly sort of the local government pension schemes, predominantly the LGBSs out there, and we manage money in private equity. So we're looking at management changes, buy-ins, buyouts, succession planning, etc., into predominantly profitable businesses where we're looking at improvements. We are, for everything we do, we are an active investor. Whether that's originating the deals, whether that's supporting teams to help them grow their businesses, we are an active investor, and that's quite an important point, and that's why we're able to command a higher fee, because actually we put a lot of effort into these businesses and help them grow. So we're in PE in that respect. We manage a very small, mainly in the northwest, mainly here. We have a Manchester office. We mainly operate in PE around this region. There's a much larger national opportunity, and that's something we're exploring at the moment. So a tiny percentage of that market we currently occupy. And then the other piece is debt and property. And again, mainly within the West Midlands, we have a Birmingham office there. That's something we're going national with as well. So again, we can see great scale opportunities. And that latter point actually in debt and property and into real assets is where there's going to be a big driver for growth within Mercia going forwards. We're labelled by our investors as what they call a place-based impact investor. So in other words, you're making returns, but you're doing it on a domestic basis or on a regional basis. You're doing more than just providing a capital return back. So we are often labelled as a place-based impact investor. And for that reason, that plays to, we have some very strong core values that sing to that. And also we hold principles within ESG very dear to us in what we do on a daily basis. And we just picked out a few things here in terms of environmental responsibility. We do that through our own offices. And through our own team, we have about 130 people at Mercia. A lot of them now take up on the electric vehicle scheme. It's things like that we can do that plays a role and plays a contribution and a part. But when you have 500 companies across your portfolio, you can influence the things they do as well. So we see that as a really important initiative and something we really value very dearly. The social impact, 100% of what we invest is in the UK. That 234 million, all in the UK. As I said, 89%, so approximately 90% outside of London in that regard. And regeneration projects. So we go into brownfield sites, we do regeneration projects, and we did 11 of those. Now these numbers are from the first half of this financial year. So this is a 6-month period we're talking about here. And then in terms of governance and diversity, Bansi joined us. She's a dedicated ESG manager, really proactive, comes from an institutional background, really helpful for us in terms of our future growth opportunities and prospects. Martin and I, part of our remuneration, part of our bonus metric is based on culture and based on ESG, quite rightly so. And then if you look at our board, 50% of our NEDs, women, and diversity in terms of gender diversity in the financial services has been a really important drive for us, a really important drive. 46% of the ExCo, 25% of the executive team, and 41% of all of Mercia are women. So it's work in progress, but I think it's a really good positive step, and we certainly pride ourselves to be above the industry in that regard and that achievement. And just really in summary, I'm hoping you picked that up from Martin and I. We are pretty passionate about the positive difference that we're making in the UK, in the regions, and for our regional fund investors, whether they're retail investors, British Business Bank, or institutional pension funds. We're very proud of the journey we're going on. You can look through all of these, you've heard from what we're saying, but that physical presence, I hope you now agree with me, is essential if you want the regions to work, if you want to see the best things, and if you want to demonstrate you're seeing the best things, return money. And returning over 800 million over this 10-year journey is a great way of showing there's good value in the regional businesses. We think there are huge structural drivers of growth for us. The tailwinds are evident. So for the increasing domestic focus, not just within the UK, but most countries are now domestically looking into how they can help their own businesses, is a huge tailwind for us. And we are tangibly seeing that. So we think there are great opportunities, and it's actually quite an exciting time we find ourselves as we get into our second year of our 3-year strategy. Thank you very much for your time, and we'll be delighted to take any questions you'd have.
Thank you, Mark. Thank you, Martin. Any questions for the chaps at Mercia? This gentleman here, please. Steve, thank you.
Thank you. I'd be interested in seeing how your share price has moved over the 10 years.
Yes. Yeah, it was as a founding investor, and a shareholder. Yeah. And you've got to remember, the founders, the employees, we own about 15, 16, 17% of this business. We're not interested. Yeah, we're depressed by it. So are the investors that joined us on our IPO when we floated at 50p. However, the simplification of the business, one of the challenges is how do you value Mercia? Is it on the future potential of its direct investments? Or is it on its ability to grow its assets under management? Or is it on its EBITDA margin? Or is it on its EBITDA total? We have concluded that actually it's all about EBITDA growth, it's all about margin, and it's all about AUM growth. And we have also concluded, and we're not going to the city to raise the money to fund that growth. And we find ourselves in the one complication, which is our direct investments, being the one solution to fund the growth. So my expectation is the market will understand what we are and put a fair value on it. But in the meantime, what we're doing is working, and we will carry on doing what is working. But yeah, I mean, you probably have never asked that question of a CEO and they don't think their business is undervalued. But actually, when you float with 23 million and you're losing money and you're turning over about 700 grand and you find yourself where you are today and your share price is almost half, then yeah, you look forward to it correcting.
Yeah, because I've been a relatively long-term investor with yourselves.
Oh.
I believe in your story.
Yeah.
But as an investor that might want to cash in, I would be losing money at the moment.
Yeah. No, and we are with you there. So the whole point of this strategy, which we're nearly a year into, is to simplify the business, because we know what an asset management business is worth on an earnings multiple. Yeah. It's pretty much standard out there. So simplify the business by removing the complexion of the direct investments.
Yeah, and if you've been a long-term investor either in us or perhaps even in the sector, you'll remember the IP groups of this world and Imperial Innovations and Allied Minds and a number of other balance sheet investment models, which is how we really started. But unfortunately, all of those have pretty much imploded one way or another. And the understandable skepticism of the stock market towards private asset valuations, in a sense, we've all been cursed, even the good guys, shall we say, who've not suffered huge problems. Has meant that that skepticism has been resulted in the share price, which is why last year we announced this pivot away from the balance sheet investment model to really focus on the profitable fund management operations, which is what, as you can see, we're scaling really, really rapidly. And so the ability to realise 120 million over time of cash in our balance sheet, in that portfolio, and deploy that into our fast-growing fund management operations through organic growth and M&A, and probably more share buybacks over time. That is the route to addressing the valuation discount, shall we say, at the moment.
Okay, thank you.
And thank you for staying with us. Thank you very much.
Got time for one quick last question. This lady here. Thanks, Tal.
And we're paying a dividend, by the way. At least we're doing that. At last. We have, since 2020, actually.
So you mentioned with the assets that you collate and stuff that you work with them to help them improve and stuff. In that aspect, I wanted to ask, do you provide consulting services then to help the businesses grow?
I can pick that up. So my background is life sciences. Spent a long time both as academic, as a startup founder in a couple of businesses before Mercia, and then co-founding Mercia. So I'm on 2 portfolio companies. I was on 2 or 3 others. And I provide my insights in terms of business models, in terms of market, in terms of networks and connections, but I don't charge a consultancy fee for that, because I'm there to, if we have serial entrepreneurs, so if, I think of Ryan at Oxygen, so Oxygen was a brilliant business, but pre-revenue, we worked really hard with them. That business exited really well. And now we're back 2 more of Ryan's businesses. That's our secret, is behavior, so that the money trusts us, the founders and management teams trust us, so that they tell their people to come to us, or we back serial entrepreneurs. So actually it's our own experiences that we bring to the businesses, which we think is the ultimate thing. Now, on occasions, there will be a US market entry challenge, or there is a business model challenge, or a technical. We're talking a lot about AI, but actually proper AI practice. I mean, AI is an enabling technology. So how is that used throughout? We use it in our business. How is it used throughout businesses? We will put an operating partner into that business from a network of trusted operating partners. So we're still not consulting, but we're putting in expertise into it, because I think the thing that fundamentally defines success are the people running the business. And as much as we can do to help the people run the business, the more likelihood there is to be success. And so it makes perfect sense to us to do that.
We run a network called Nucleus, Mercia Nucleus, which is 1,000 people who can provide expertise and assistance to those portfolio companies.
Brilliant. Very comprehensive. Thank you very much,
Always a
gentlemen.
pleasure.
Thank
Always
you,
Thank you,
Martin.
everyone. Thank you.